The Federal Reserve doesn't manage the economy for you. It manages it around you. Every policy, interest rates, bond purchases, quantitative easing, sounds like some distant macroeconomic process, but in reality, it directly shapes how your savings, your salary, and your future purchasing power behave. For most people in the middle class, the logic seems simple. Work hard, save money, avoid debt, and keep cash for security. That mindset worked in the 1980s and even into the early 2000s, when money kept its value and banks paid real interest. But today, that same strategy silently destroys wealth. Because the financial system changed while people's behavior didn't. Since 2010, the Federal Reserve has printed over $8 trillion into circulation through quantitative easing programs. The goal was economic stability, but the outcome was predictable. Asset prices exploded while wages barely moved. Between 2010 and 2025, the S&P 500 index grew by roughly plus 250%. The median home price doubled. And yet the median household income in real terms increased by only plus 15 to 20% after adjusting for inflation. The result is a widening gap not only between rich and poor, but between those who own assets and those who don't. This matters because the Fed's policies don't reward effort, they reward ownership. The more assets you hold, stocks, real estate, equity, the more you benefit from the policies that inflate their value. If your income depends on labor alone, every rate hike and stimulus cycle moves you backwards. Your paycheck might nominally rise, but its purchasing power is eroded by a system designed to protect capital, not labor. Many people believe the Fed fights inflation by raising interest rates. But that's only half the story. When rates rise, borrowing costs increase, mortgage payments rise, small business loans dry up, and credit card balances balloon. Households cut spending, the economy cools. But asset owners already locked in cheap, long-term debt when rates were low. They simply wait out the cycle. Those without assets take the hit now, and again when inflation drops but prices don't return to pre-crisis levels. Let's put it in numbers. A household earning $70,000 per year, keeping 15% of income in savings, ends up with about $10,500 saved annually. At 3% inflation, official CPI, they lose $315 of purchasing power the first year. But real inflation, for essentials like housing, energy, and food, runs closer to 6 to 8%, meaning their annual savings lose $700 to $800 in value before they even invest. Over 10 years, that's more than $7,000 in lost purchasing power, not counting missed asset growth. They think they're being financially responsible, but the hard truth is, they're funding the system that makes them poorer. Their cash savings fuel bank lending. Their tax dollars fund new stimulus programs. And their labor income is taxed at the highest effective rate compared to capital gains. They're doing what the system told them was right. Work, save, stay out of debt. Yet all three behaviors now work against their own financial survival. That's the core problem. The Federal Reserve doesn't hide data. It hides incentives behind complex terms. Liquidity injection, asset balance sheets, target inflation. And because most people don't own the kind of assets these policies inflate, they never see the gains, only the side effects. The middle class was trained to think in terms of cash and effort, while the wealthy think in terms of leverage and inflation. That difference, not income, not education, defines who moves up the wealth ladder and who stays stuck under it. The system isn't broken. It's working exactly as designed. The problem is that the middle class operates under assumptions that no longer match the environment they live in. Most households depend on earned income, wages, salaries, or small business earnings. That income is linear, time and effort in exchange for money. In contrast, the upper 10% earn most of their income from capital, ownership of stocks, real estate, or businesses. That income is exponential because it scales without equal effort. When the Federal Reserve expands the money supply or keeps rates artificially low, the value of capital rises faster than wages can ever catch up. In 2025, around 65% of all U.S. wealth was held in financial assets, stocks, bonds, and funds. The top 10% owned over 88% of that. Meanwhile, the bottom 90% kept most of their net worth in cash or low-yield bank deposits. So, when asset prices climb due to monetary expansion, almost all the benefit accrues to the top decile, while the middle class watches inflation quietly erase their savings. Take two families as a practical example. Family A earns $80,000 per year, saves 10% in cash, and avoids debt. They focus on stability. Family B earns the same amount, invests 10% monthly into a broad market ETF, and uses a fixed-rate mortgage to purchase a home early. After 10 years with average inflation of 3% and market growth of 7%, both families earned roughly the same income. Yet Family A's $8,000 annual savings have barely retained purchasing power, a total of approximately $90,000 saving that's worth less each year. Family B's investment, compounding at 7%, grows to over $110,000, plus home equity gains from inflation-driven appreciation. The difference isn't income, it's structure. One built a system that protects them from inflation. The other relied on discipline that no longer works under Fed-driven monetary expansion. Typical financial advice, save cash, reduce debt, avoid risk, makes sense in a stable currency environment. But we haven't lived in one for decades. Since 2008, the dollar's purchasing power has fallen by more than 25%, while total debt across all sectors has increased by over 70%. In that environment, playing it safe means guaranteed loss. Cash no longer stores value. It transfers it to those who own appreciating assets. The middle class often misunderstands leverage. They associate debt with danger because consumer debt, like credit cards or payday loans, erodes wealth. But productive debt, tied to appreciating or income-generating assets, does the opposite. When inflation rises, the real cost of long-term fixed-rate debt shrinks. The asset side inflates, while the liability side deflates in real terms. That's how wealthy households use the same economic forces that hurt savers to build more equity. The reason most people don't replicate this approach isn't lack of intelligence, it's lack of framework. Schools teach budgeting, not capital mechanics. Employers encourage 401k contributions, but don't teach the impact of real interest rates. As a result, the average person continues to operate tactically, month by month, while the system itself operates strategically, decade by decade. So when central banks adjust rates or inject liquidity, the average worker reacts emotionally. Reduce risk, save more, slow spending. The wealthy respond structurally, refinance, acquire, diversify. That difference compounds over time until two households with identical incomes live in entirely different financial realities. The modern economy doesn't reward effort, it rewards structure. And until the middle class rebuilds the way they think about money, not how much they earn, but how their income flows through assets or loses value, the gap will keep widening no matter how much the Fed explains its policies. 3 specific behaviors trap the middle class in a financial dead end. None of them relate to income level. They relate to decision-making systems. Mistake number 1. holding excessive cash savings. The average American household keeps $15,000 to $20,000 in liquid cash beyond emergency funds. That money earns 0.5 to 1% in high-yield savings accounts, while inflation averages 3 to 4%. Over 5 years, $20,000 loses $3,000 to $4,000 in purchasing power. Over 20 years, that same amount loses $12,000 to $15,000, even without considering higher inflation spikes during stimulus periods. The cash doesn't disappear. It transfers value to asset owners as prices rise. Mistake number 2. Aggressively paying down productive debt. Mortgages and business loans represent leverage opportunities when tied to appreciating assets. Yet 60% of homeowners prioritize extra mortgage payments over investing. Consider a $300,000 mortgage at 4% fixed rate. Extra payments reduce principal, but miss the opportunity to invest those dollars elsewhere. Over 10 years, paying down $50,000 extra saves $20,000 in interest, but investing that same $50,000 at 7% market returns generates $70,000. The net difference, $50,000 lost opportunity. In 20 years, that gap widens to $200,000 plus. Debt isn't the enemy, unleveraged debt is. Mistake number 3. Relying exclusively on earned income without ownership stakes. Only 28% of middle-class households own stock market exposure beyond retirement accounts. They depend on raises and overtime, which grow 2 to 3% annually. Capital markets, despite volatility, average 7 to 8% long-term. A household earning $80,000 who invests 10% of income in broad market assets builds $300,000 in 10 years. The same household saving the same amount in cash builds $120,000, 60% less. Now project these behaviors forward. 5-year horizon. A family saving $10,000 annually in cash sees inflation erode $2,000 to $3,000 of value. They feel secure, but end up with less real wealth than when they started. The same family investing builds $55,000 to $60,000 and actually gains purchasing power. 10-year horizon. Cash saver ends with $120,000 nominal, worth $90,000 in today's dollars. Investor has $300,000 nominal, worth $220,000 in today's dollars, more than double. 20-year horizon. Cash saver's $240,000 nominal shrinks to $150,000 real value. Investor's $1 million nominal equals $600,000 real value, 4 times more. These aren't optimistic projections. They reflect historical S&P 500 returns of 7.2% annualized since 1957, adjusted for 3% inflation. The key insight? These outcomes occur regardless of income. 2 households earning $60,000 versus $120,000 produce identical results if they make identical decisions about cash, debt, and ownership. The $120,000 household with cash/debt habits ends up poorer than the $60,000 household with asset ownership. Income funds decisions. Decisions build wealth. Over 20 years, the middle class collectively loses trillions in purchasing power to these 3 mistakes. Not because they don't earn enough, because they don't structure what they earn correctly. The Federal Reserve's policies create the environment where these mistakes compound, but the individual household creates the decisions that make them fatal. The solution isn't complex investing or market timing. It's a 3-part system that uses the same inflation forces working against you to work for you instead. Step 1. Redirect cash into inflation-resistant ownership. Stop holding excess savings beyond a 3 to 6 month emergency fund. Take every dollar above that threshold and move it into broad market ownership, specifically low-cost index funds tracking the S&P 500 or total stock market. These funds hold thousands of companies, spreading risk across the entire U.S. economy. How it works. When the Federal Reserve prints money or lowers rates, asset prices rise. Your ownership stake rises with them. Historical data shows S&P 500 returns averaging 7.2% annually after inflation since 1957 through recessions, wars, and pandemics. A $10,000 investment grows to $20,000 in 10 years, $40,000 in 20 years, without you picking individual stocks or timing the market. Step 2. Use fixed-rate debt as inflation leverage. Keep productive debt, mortgages, business loans, at fixed rates below 5%. Don't accelerate payments. Inflation erodes the real value of that debt over time. How it works. You borrow $300,000 for a house at 4% fixed in 2025. 5 years later, with 3% annual inflation, that debt's real value drops to $260,000 in today's dollars. Meanwhile, the house value likely rises from $350,000 to $420,000 due to inflation-driven appreciation. You gained $70,000 equity while your debt burden shrank by $40,000 in real terms. The bank doesn't care. They get paid back in weaker dollars. Step 3. Automate with dollar cost averaging, DCA. Set up automatic monthly transfers from checking to investments. Invest the same amount every month, regardless of market conditions. $500, $1,000, whatever fits your budget. How it works. Markets fluctuate. When prices drop 20%, your fixed monthly investment buys 25% more shares. When prices rise, you buy fewer shares but at higher value. Over time, this averages your cost basis lower than any single entry point. Data from Vanguard shows DCA into S&P 500 from 2008 to 2025 produced identical returns to lump sum investing, with 30% less volatility exposure. Why this system stays stable, not risky? Diversification. S&P 500 index funds hold 500 major companies. No single stock failure destroys your portfolio. Time horizon. 10+ years smooths out market cycles. No bear market since 1957 lasted more than 3 years. Inflation hedge. Both stocks and real estate rise with or above inflation long term. Behavioral guardrails. Automation removes emotion. You don't sell low or buy high. Real math example. Household earns $80,000, invests $800 per month, $9,600 per year, via DCA into S&P 500 ETF. After 10 years, $145,000 total invested grows to $200,000. Same household keeping $9,600 per year in cash, $96,000 nominal value, worth $75,000 after inflation. Difference: $125,000. This isn't speculation, it's arithmetic. The Federal Reserve creates inflation. You capture it through ownership and leverage instead of fighting it through cash preservation. The system requires 15 minutes monthly to monitor, set transfers, confirm allocations, rebalance annually. Wealth isn't created by earning more. It's created by owning what inflation makes more valuable, borrowing what inflation makes cheaper, and staying invested through every cycle the Fed creates. Here's your complete anti-inflation system. 5 steps executed monthly. No complexity, No speculation, just arithmetic that works with how the Federal Reserve actually operates. The full system. 1. Maintain 3 to 6 months' expenses in cash, $15,000 to $30,000 maximum, depending on household size. This covers emergencies without tying up capital. 2. Automate 10 to 15% of income into S&P 500 Index Fund, Vanguard VOO, or Fidelity FZROX. Set recurring transfers on payday. 3. Keep fixed-rate debt under 5%. Mortgage, auto loans if necessary. Minimum payments only. Inflation handles the rest. 4. Annual rebalance. January 1st. Insure 80% stocks/20% bonds if over 50, or 90/10 if under 50. Takes 15 minutes. 5. Track net worth monthly. One spreadsheet. Assets minus liabilities. Adjust contribution rate up 1% yearly as income grows. What changes over time? Specific projections from $80,000 household, $10,000 annual investment. Year 1. $10,000 invested. Portfolio value approximately $10,200. 2% gain despite volatility. Cash savings preserved, no erosion beyond emergency fund. Debt burden shrinks 3% in real terms. Net worth up 1 to 2% overall. You notice smaller losses to inflation. Year 5. $50,000 total invested grows to $65,000, 7% annualized. Home equity up $25,000 from appreciation. Total net worth, $90,000 new wealth versus $40,000 if cash saved. 50% of your money now works independently of your labor. Year 10. $100,000 invested compounds to $170,000. Home value up $75,000. Total net worth, $250,000 new wealth versus $75,000 cash scenario. Investment income covers 15 to 20% of living expenses. You've escaped linear income dependence. Year 20. $200,000 invested becomes $500,000 plus. Home equity doubles. Total net worth exceeds $800,000 versus $150,000 cash. Passive income replaces 40 to 50% of former salary needs. What to do starting today? Exact sequence. 1. This weekend. Open brokerage account at Vanguard, Fidelity, or Schwab. 0 commissions. 2. Monday morning. Transfer $1,000 from checking to buy VOO, S&P 500 ETF. 3. Tuesday. Set recurring $500 to $800 monthly transfer from paycheck to same ETF. 4. This month. List all debts. Identify fixed-rate loans under 5%. Commit to minimum payments only. 5. January 1st. Build one-page net worth tracker. Google Sheets template. Personal capital free version. The logic behind stability. This system survives every Fed policy since 1957. Rate hikes, crashes, stagflation, dot-com busts. S&P 500 never had a 20-year negative period. Fixed debt gets cheaper every inflation cycle. Automation eliminates human error. You don't need to predict recessions or rate cuts. You profit from both. The Federal Reserve creates the environment. You capture the outcome. Cash savers lose purchasing power to inflation 3 to 4% yearly. Owners gain from asset inflation 7 to 8% yearly. The math difference compounds to millions over decades. This isn't theory. Households executing this exact approach since 2010 turned $100,000 investments into $300,000 plus by 2025. They didn't time markets. They didn't pick stocks. They owned the system the Fed built. Start with one ETF purchase this week. The gap between your current path and this system widens $20,000 per year immediately. In 10 years, that's a different financial life. Execute the 5 steps. The results follow.